Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
Speaking of next week, we want to be as relevant as possible with our game plan. So let's not bury the lead because on Friday, it's going to go right to it. On Friday, we get the September non-farm payroll report. And this is the single most important number we get from the government. If we're going to have a strong October, we got to start with this. Start with a softer unemployment number that shows some slack in the labor force. Otherwise, we'll spend the whole month worrying that the Fed's going to lower the boom on us to cool things down. Now, this is a tough call because we don't want to see any sort of wholesale economic collapse, because then we're worried about earnings per share, earnings cut, forecast down. But we also want to see consistently strong unemployment numbers, because then Fed Chief Jay Powell has no wiggle room, and interest rates are going higher, starting with the longer end. Now, I continue to believe that come the end of October or to November 1, when the Fed meets and then talks, we'll get a quarter-point rate hike, and longer-term rates will follow. I think the yield curve, which has been inverted, will finally switch back to normal, and the yield on the 20-year Treasury will likely pass short rates and go near 6%. But that will not be a disaster, people. It will not. See, I know that it'll be seen as negative for the stock market, but if you hop in the Wayback Machine with Mr. Peabody, you'll find out that we've had plenty of markets in the 80s and 90s when rates went higher and stocks rallied anyway. Rallied strong in some cases. Of course, if the employment data is on the softer side and it looks like we're at the beginning of sustained weakness, then the Fed might be done tightening. In that case, longer-term rates may start going down. The market could be up huge, and that's why the bulls are rooting for economic weakness. It's the only thing that can make the Fed stop. It could be an explosion of stock prices if we get what I just mentioned.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.